Have you ever wondered why some people seem to have an endless stream of income while others struggle? Well, it's no magic trick, folks. It's called investment. Imagine planting a seed, nurturing it, and watching it grow into a fruitful tree. That's what investment is in a nutshell. It's about growing your money. It's a path to financial freedom and stability. Remember, investing is not just about making more money, it's about securing your future and achieving your financial goals. Ever heard the saying, "Don't put all your eggs in one basket"? This is the essence of the diversification strategy. Imagine you're at a carnival trying to win that giant stuffed bear. Would you throw all your balls at once, hoping one lands? Or would you spread out your throws? That's the gist of diversification. Instead of investing everything into one asset, you spread your investments across a variety of assets. It's like betting on multiple horses in a race. You might not pick the fastest one, but you're less likely to pick the slowest one. But why do we diversify? It's all about risk management. Every investment carries some level of risk. By spreading your money across different types of investments, you reduce the risk of a single investment damaging your entire portfolio. Think of it as an insurance policy on your investments. Of course, there's a trade-off. While diversification can limit your losses, it can also limit your gains. If you put all your money in one stock and it skyrockets, you could become a millionaire. But if that stock tanks, you could lose everything. Diversification balances out the highs and lows, giving you a smoother, more predictable investment journey. Don't get me wrong, diversification isn't about playing it safe. It's about playing it smart. It's about understanding the risks and rewards and making informed decisions. Diversification is like a safety net for your investments. It might not make you a millionaire overnight, but it can protect you from losing it all. Ever go shopping for bargains? Then you might already have a knack for value investing. Now let's dive into what this strategy actually entails. Picture this. You're at a yard sale, eyeing an old dusty vase. It's priced at $10, but with a little bit of cleaning and some TLC, it could easily fetch $100. That's value investing in a nutshell. It's about finding assets, stocks, bonds, real estate that are undervalued and expected to increase in value over time. This strategy requires a healthy dose of patience, as these bargains may take time to yield returns. It also demands thorough research to accurately identify these undervalued assets. So you're not just a shopper here, you're a detective, hunting for clues, doing the legwork, and finding those hidden gems. Value investing is all about spotting diamonds in the rough. It takes time and patience, but the rewards can be great. If you're the kind of person who likes to bet on the future, then growth investing might be your game. Now, what's this all about, you ask? Growth investing, folks, is all about putting your money on companies that are expected to grow at an above-average rate compared to other companies in the market. Imagine this. You're at a racetrack, and you're looking for the horse that's got the potential to outrun all the others. That's your growth company right there. It's young, it's spry, and it's got a lot of room to run. These kinds of companies often reinvest their earnings back into their business, fueling more growth and potentially leading to higher stock prices. This could mean a bigger bang for your buck in the long run. But here's the catch, just like that racehorse, there's some risk involved. The company might stumble, or it might not grow as fast as you'd hope. It's a bit like betting on the dark horse. You might win big, or you might lose your shirt. Also, growth stocks typically don't pay dividends, as the profits are reinvested to fuel further growth. So, if you're looking for a steady income stream from your investments, this might not be the strategy for you. Growth investing is like riding a roller coaster. It can be thrilling, but it's not for the faint of heart. So buckle up and get ready for a wild ride. If you like the idea of your investments paying you a regular income, then you might be an income investor. Imagine, every quarter or so, your investment portfolio hands you a paycheck. That's the essence of income investing. This strategy focuses on securities that generate a regular income. We're talking about things like dividend-paying stocks, bonds, real estate investment trusts, or even peer-to-peer lending. Now here's the deal. This approach is often favored by retirees or those seeking a steady cash flow. Why? Because it can provide a predictable and, in many cases, a relatively safer return on investment. It's like having a regular paycheck, but without the 9-to-5 grind. But don't get it twisted. While it can provide a steady stream of income investing is not typically a get-rich-quick scheme. It requires patience, diligence, and a well-diversified portfolio. So remember, income investing is like having a job that pays you even when you're not working. Ever wish you could take some of the guesswork out of investing? That's where dollar-cost averaging comes in. Think of it as a sort of set-it-and-forget-it strategy. Here's how it works. You choose an asset, let's say a particular stock or mutual fund, and invest a fixed amount in it at regular intervals. This could be weekly, monthly, or quarterly. The key here is consistency. Now you might be thinking, why not just invest a lump sum all at once? Well, the beauty of dollar-cost averaging is that it can help reduce the impact of market volatility. We all know the market has its ups and downs, and timing those peaks and valleys can be tricky, if not impossible, for even the most seasoned investors. By investing the same amount over time, you'll buy more shares when prices are low and fewer when prices are high. This approach can average out the cost of your investment over time, hence the name dollar-cost averaging. This strategy may not bring you the highest possible returns, but it can help safeguard you against major losses, especially during market downturns. It's a cautious, disciplined approach that favors long-term stability over short-term gains. Remember, investing is not just about making money fast. It's about growing your wealth steadily and securely over time. Dollar-cost averaging is like a slow and steady race. It might not get you to the finish line first, but it can help you avoid major pitfalls along the way.